Let's back up a little bit and talk about ETF and overall ownership trends. Mike, you're seeing a stronger bifurcation between institutional and individual investors, and that actually is concerning to you. Why?
Well, I think product proliferation in the ETF market is at its all-time high right now. And if you look at the ETF market and break down ownership of the ETF market, it gives you a sense of how these products are being used. So as a just baseline, about 64% of the entire ETF market can be traced back to 13F filings, which gives you a sense of the
Mm,
institutional ownership of ETFs. If you look at this and then start going downstream a little bit into leveraged and inverse or single stock ETFs, these have seen incredible amounts of assets come into them. Single stock ETFs have over 30, almost $40 billion in ETFs in them, sub 10% institutional ownership. And the institutional ownership that does exist is purely there to provide the trading and the liquidity for the retail ownership. So I think if you just go through the ETF market and look at ownership percentages by different categories, and a great example is, not to pick on ARK as a example of this, but during the COVID years when markets went really through the roof in terms of flows into very niche thematic themes, those types of ETFs have very low institutional ownership, so it's driven by the retail investor. We are seeing signs of all of those types of niche strategies, especially in the thematic and innovative space, starting to approach 2020, 2021 types flows again, right at the top of the market. And that I think is a concerning concept, and a great way to dissect it is to look at, hey, is this product being professionally allocated at the whole, or is it being allocated mostly by retail? And I think we're seeing in a lot of these more niche, newer areas of the ETF market, it's being driven by retail.
yeah, and your point about kind of the analogies between 2020, 2021 time frame and today ring true in that area too. Let's dig a little deeper into those thematic and single stock pockets that individuals are growing into. Specifically, which areas of the market are those in? Where is retail kind of finding its footing?
Well, single stocks is $40 billion now, and it can be broken up between leveraged products and covered call or synthetic income. Really, it's synthetic calls on single stocks. So for an example, MSTY trace, they're generating yield off of MicroStrategy, right? These strategies are incredibly volatile. They're 99% owned by retail. There's no institutions allocating to these strategies, but there's billions of dollars coming into them. And the old saying, everybody's a genius in a bull market. These things have held up in terms of the not having a NAV erosion because their underlying have done so well. But if you have a yield covered strategy that's paying out 100% income on an annual basis and the underlying doesn't keep going up, it's a train wreck. And it's waiting to happen. And I worry about that area of the market. Now, I think you can separate that from thematics. I actually believe that thematics are great portfolio allocation tools, whether it's good old fashioned infrastructure, natural resources, or thematic growth like ARK does. But when you start seeing the flows into those products take off, generally that to me is a contrarian signal that we're overheating across the market. And that's been shown time and time again in terms of money flows chasing returns.
Yeah, and kind of what it means when all of that flushes out, and a lot more people are affected by that. Joe, what are you seeing in terms of individual interest in gold ETFs, either as a hedge or speculation? What is kind of the flows behind the scenes tell you about the overall market?
So traditionally, we've seen the institutional and the retail, the aggregator of retail flows, being about a 50-50 split. We still see that to be kind of the overall holding of how the ETF landscape looks. But we're getting a lot more questions from institutions, and people are actually moving away from hedging or speculation, and they're really looking at strategically allocating the gold. The number that's talked about quite a bit is 3 to 5%, looking at portfolios and understanding while risk remains top of mind, allocating the risk assets. We're seeing most people looking at gold and saying, I need to find a cost-effective hedge against drawdown moments, against moments when I know I need certainty in my liquidity. And with people's appetite taking on higher risk to chase return, they're understanding that gold fits in that portfolio. Now, to date, we've seen about 40 billion flow into the exchange traded funds on a worldwide basis, another 4, that's through the first half of the year, and another 4 for July and August. We expect that trend to continue. And I think that what we're starting to see right now is that tipping point. It'll probably need the catalyst of a rate cut from the Fed so that people will start moving more aggressively into the gold allocations, but that's what we're sensing now. And institutions are calling us on a regular basis saying, look, we need to talk about how gold fits in and how we can use it for hedging.
Yeah, if I guess cash gets, more expensive from a cost of capital standpoint relative to gold, then that could shift some of the money market fund capital into that as a diversification play.
And one last point that Mike raised, which is central banks. For the last 3 years, we've seen record or near record flows with central bank activity. Now we're on track to see something maybe a little slower this year, but it's still very significant. So between investment and central bank flows, those are 2 driving use cases that will continue to make gold perform exceptional.
Yeah, it's been a remarkable sea change on that front. Thank you very much, Joe. My thank you to you as well, Mike. You can catch that and all of our other content at etfedge.cnbc.com. Thank you for watching.